In this next segment, we'll be talking about credit, life, and disability, something that's been around since the early 1900s. Most people don't know the product was created at a time when you couldn't get a loan unless you had money. The only type of loan you could get in the early 1900s was a secured loan, and it was secured with cash. Credit insurance came about when a gentleman by the name of Arthur J. Morris decided to create what was known as the Morris Plan. And the Morris Plan simply stated we would loan money to people who didn't have the money based on their time on job, based on their time in community, based on their ability and willingness to repay. Some of the same things that we base credit ratings on today. The thing that Arthur Morris could not predict back in the early 1900s was death or disability. So somewhere along 1937, Arthur Morris tied to his installment loans the Morris Plan that if you were to borrow money from Arthur Morris, that no man's debt should outlive him. While he realized he could collect from a widow, it was relatively difficult knowing she didn't have the resources to pay when the primary breadwinner had passed away. While he realized he could collect from an individual disabled in the hospital, it was rather uncomfortable realizing the individual didn't have the resources at the time, because now he has had medical bills that have been incurred. He's now got a loss of income, and he's not in a position to pay the debt the way it was designed. There hence the development of credit, life, and disability, and the phrase that Arthur Morris had coined, no man's debt should outlive him, because at that point in time, he made it possible for every individual that borrowed money from Arthur J. Morris that if they were to die before their loan was paid in full, the loan would be settled for their survivors. If they were to be disabled before their loan was complete, he'd carry the payments for them until they were able to go back to work. And if they never went back to work, all the payments would be made. You can imagine how popular that was for borrowers back in the early 1900s. Unfortunately, through regulation, it was deemed as insurance, and it was forced to be regulated, it was forced to be underwritten, and what we know today as credit, life, and disability was spawned from that time frame. Over the years, we've had a lot of success with life and disability. It's become increasingly difficult with regulation from state to state. In some states, the product's not even offered, at least on a routine basis. But as we sit here today, there's one overarching fact. And that fact is that people today are buying things today with tomorrow's money. Simply put, if they die or become disabled prior to tomorrow's money's coming in, this debt will default. It is the number one reason for default installment lending. Death and disability, number one reason for default in installment lending. And in fact, today, I think you'd agree, if we were to exit interview a customer leaving our finance departments today with two incomes shown on a credit statement, and we were to ask the customer, hey, would this be a problem repaying the loan if one of these two incomes were missing? I think we'll find the answer is obvious. Yes, it would be a problem. My question to you at that point is, why wouldn't they need credit, life, and disability? We know it's an expensive product. It is because the amount of money that we have to pay should a customer die is significant. If you think about this, a customer today could get into an installment loan, never make the first payment, drive across the street, and be in a bad accident, or could have had a massive heart attack and died, an unforeseen death. And we have an outstanding debt of $40,000 or $50,000 before the first payment was made. That's what makes the product expensive. What's the other thing that adds to the price of the product? It's the same rate whether you're 18 or 65. So it's a balanced rate. The closer you are to 65, the better deal it is, because it's a very competitive rate. You could literally say to a 60-year-old man, did you realize that you could get an insurance policy to the day at the same rate as an 18-year-old? That's attractive to an individual who's 60 years old, because his awareness for the value of insurance is much greater than it was when he was 20. When you talk to an individual today who's 55 years old and you ask, were you aware that you could get a disability policy at the same rate as an 18-year-old? That's attractive, because it's rather difficult to qualify for a disability policy. There are blood tests, there are EKGs, there are numerous questions through 3 or 4 pages that have to be asked. There are all types of things that disqualify you today for a normal life or disability policy, like your occupation, whether you skydive, whether you scuba dive, whether you race professionally, or whether you fly private airplanes. These things aren't factors in credit life insurance. Outside of a few basic questions, in some cases from 2 to 5 years, asking if there's any life-threatening illnesses or any pending disabilities, which we would know as pre-existing conditions, customers are able to secure life and disability policies instantly with no money up front, and they're insured from the moment they leave our dealership. Now, most importantly for the consumer, it's put them in a position to secure their credit. We know subprime financing has grown tremendously over the years. One of the number one reasons that we've clearly pointed out for failure in installment lending is death and disability. But I have news for you. One of the number one reasons why we have a special finance department today with subprime lending, with customers paying upwards of 20+% installment loans, is because they had an unforeseen event happen in their life. When you look at a credit bureau, most of the time we're dealing with a hospital collection or an ambulance collection. It's a medical associated situation with the customer's credit. And for a few dollars a month, it could have been avoided. Credit life is a great deal for a customer. It's an awesome deal for the customer if they need it. I'll agree with you. If they buy the policy and they never had a life claim, they never had a disability claim, the premium didn't amount to much. It's a little bit on a monthly payment to insure a tremendous liability. Like other forms of insurance, LA&H, life, accident, and health is regulated by the state. Simply put, in most cases, this means the price of the product is held to be very competitive. In many states, it continues to be reduced in price, and today we're selling a product with misconceptions. In many states, over the last 5 years alone, it's been reduced down 40 and 50% in premium, and it's still covering the same benefit. It's a better deal today than it's ever been. Why do we not sell it many times? We're not comfortable talking about it. We don't understand it. We don't have the time or the depth or the comfort level to talk to the customer about what the probability of death and disability is. But the bottom line is, people do die in installment lending. The bottom line is, we do have to settle debt for the spouse. And when a customer returns to the dealership to state that the primary buyer had died and they no longer need the vehicle and they can't afford the debt, and many times those customers are owing more on the vehicles than they're worth, and the only way out is that the customer were to produce $8,000 in cash to close the difference between the value of the vehicle and what is owed on the vehicle at the time of loss. For $15 a month on life insurance, $15 to $20 a month on life insurance, in many cases $25 to $30 a month on disability, it could have been avoided. Yes, it's big on the payment, but it's huge on the return when it comes claim time. The majority of consumers today are under or uninsured. In many cases, consumers believe that $100,000 worth of life coverage is a significant amount of coverage when we know today mortgage balances far exceed that $100,000. There's a reason why the lender will automatically advance, in most cases, the credit life and disability premium. It's to protect their interest and the consumer interest, the thing that Arthur Morris knew back in the early 1900s, that if a man were to die or if a man were to become disabled, he would not be in position to repay the debt. And that's why you will find this product automatically advanced by the lender.